Hi student, it's Kate here. Come back to problem 6.24 part 4. So part 4 requires you to prepare the cash budget. So because this part is quite complex, so I would like to go through the question, the detail of the question, information that they give you here, and then help you to transfer that information into the spreadsheet. So here I already have the spreadsheet, but what I want to do is to go through the details of the information and then to show you how it's reflected in these orange boxes. So you see that the first thing is the sales collection. Here's the sales pattern, okay? So you remember you have the total sales budget of 80,000. Then it is distributed here in each of the quarter following this pattern. And then from sales you can collect money. So that is the source of money collection, the receipt. All right. So the receipt has a pattern like this: 50% in the month of sales, 47% in the months after the sales, and 3% bad debt. And in the beginning of the year, which is the beginning of January, we also have an account receivable of 90,000 to be collected. That is from the sales in December. So how this bit of information presented in our in our spreadsheet. So you can see here is account receivable balance is 90,000, and the collection of patterns is in here. Okay, in the month of sales 50%, 1 month after sales 47%, and bad debt 3%. And the distribution of transaction, we want to know what happened when. So the first thing is sales. So this is the source of cash receipt. So this is the patterns of sales: 10% in first quarter, 50% second quarter, 30% third quarter, and 10% the last quarter. The second thing is, you know that for the manufacturing company, the main payment would come from the purchase of inventory. And the inventory here is raw materials, right? So because they say that they want to maintain the beginning inventory quantities during the January and February, and then increase the inventory to targeted level by the end of March, and maintain those levels throughout the rest of the year. So from this information, later on we will calculate the purchase per month. From the purchase per month, we will know how much they have to spend, and then you have to see what is the pattern of payment for purchase. So you see here, for the purchase of raw materials, they pay 2/3 in the month of production, and 1/3 are paid in the following months. And for account payable, they have $13,000 to be paid in January. So account payable here, 13,000 opening balance, and the payment patterns 66.66% in the month of production, and 1 month after production 33.33%. Okay, so that is a main cash receipt from sales and cash payment from purchase of raw materials. So there's other operating expenses that we have to think about here. So you see that the employee wages and other production costs are paid during the month incurred. So basically, for instance, direct labor cost, we only pay when we produce things. So we need to know how much we produce each month, and based on that we know how much we pay for the employees. And also other variable cost, not the fixed cost, but other variable costs also is paid in the month that is incurred. So actually we have to work out how much we produce each month first, and then we can work out how much we pay for other production cost. But there's one portion of the production cost that you can predict now, which is the manufacturing, the fixed part of manufacturing overhead. So other fixed overheads is equally distributed. So I put that 25% each quarter. Okay, so the next part is the property tax. They say the property tax are paid in 2 equal installments on the first quarter and the third quarter, and the insurance is paid 100% in the second quarter. So we transfer this information here. So you see that the property tax 50% paid in the first quarter and 50% paid in the third quarter. The insurance 100% paid in the second quarter. So that is a cash outflow, right? So I can put like the plus here is the cash inflow, minus here is the cash outflow. For the supporting costs, they say the supporting cost is distributed evenly throughout the year. So I put 25% each of the quarters, and that is a cash outflow as well. The next part is the sales of equipment. The sales of equipment, they say they collect 10,000 in January. So that is a cash inflow, which is the receipts. 10,000 happened in the first quarter. They purchase and pay for the new equipment in January. So that is a cash outflow of 50,000 in the first quarter. The income taxes are paid evenly throughout the 4 quarters. So that is 20% each quarter. So it is also a cash outflow as well. So you see, what they do is they estimate the amount of net profit, and then they estimate the amount of income tax expense. So, and then they divide that into 4 equal parts and pay that evenly throughout 4 quarters. Now come to the short-term bank credit. The opening balance for the short-term loan is 150,000, and the interest rate is 5.5% per annum. And in order to maintain this credit line, they have to have the minimum cash balance of 100,000. So from the information you are given in the question, we transfer it to into the spreadsheet like this, and we will use this information to prepare the cash budget. So watch the next video for preparing the cash receipt. Thank you.